Alrighty guys, so e.l.f. Beauty, let's dive into this. Holy smokers, this is no dang jokers. Check this out. They just finished up their fiscal year 2024. Net sales up 77%. Gross margin up 330 basis points, which is a fancy way of saying 3.3 percentage points. Adjusted EBITDA was up over 101%. In market share, they gained over 305 basis points of market share. They are eating everybody's lunch in this cosmetics industry, okay? Check out the consecutive sales growth. 21 consecutive quarters of net sales growth. I mean, recently they've been growing the business 70+%. Just a shocking number overall. Cosmetics consumption's up 30% for them versus the category's actually down. That's incredible when they've got 30% growth and the category itself is down, right? They're growing market share. If you look at their competitors, which, you know, companies like Maybelline, L'Oreal, CoverGirl, Revlon, right? These ones are actually losing dollar share, right? And e.l.f. is gaining massive dollar share overall. If we look at the skincare, because you got to understand there's cosmetics, which, you know, might be eyeliner, it might be, you know, foundation, lipstick, things like that. But then there's skincare, which is like if you have a skincare routine, you know what I'm talking about, right? It's making sure your skin's always fresh and using different products in that frame. It's not really about like, let's put eyeliner on and those sorts of things, right? Let's put mascara on. That's not what skincare is, okay? So skincare segment, they about 19x the skincare consumption versus the category, okay? So which means, once again, they're outgrowing everybody else by a large margin. They're taking major market share. If you look over here, as far as the share gain, they gained about 45 basis points here, and they're up to number 11 brand in skin. And so they have a long way to run here in the skin category overall. They bought this company out. They paid $300 million plus for it. The deal closed back in October. Naturium, okay, and this brand is very, very successful in skincare. It helped the company out 17 percentage points when it comes to net sales growth as well, and this one has a long runway of growth ahead of it. It's going to be very substantial for e.l.f.'s business model in the future. Now, international sales are off the charts for e.l.f. Look at this. Look at this. Who's putting up these sorts of numbers, right? This is what frustrates me a little bit about the stock market. People, you know, they're like, oh, you know, I don't wear makeup, so it's not relevant to me. I'm like, the numbers can kind of show you what's going on here, man. I think it might be worth paying attention to a little bit at least, right? International net sales growth up 115%. Booming international sales growth, right? In Canada, they're up to number 3 in market share, and in the UK, they're up to number 4 now at this point in time. And when I look at e.l.f., it's just a matter of time before they come to the number 1 position in all these different markets, okay? Number 1 in all of them. Now, if you look at their pricing versus their competitors, they brought this out here, $650, you know, versus $950 versus $20 roughly or more for prestige brands. Here's the deal. e.l.f. is good in any environment. Throw a recession at e.l.f., they'll handle it. Throw high inflation at e.l.f., they'll handle it. Throw deflation at e.l.f. and they'll handle it. And the reason being is because they undercut their competition as far as pricing goes, and by not a small amount, by quite considerable amount of money, right? And so whatever happens. You got to understand, if their other competitors are losing market share, well, likely they might have to go up on price. If they drop price, plus they're still losing market share, then that could just cause their margins to completely fall apart and their whole business model to completely fall apart. So their competitors are kind of stuck trying to charge the same price or even a higher price as they lose market share overall. They can't really compete like that where they're like, let's bring down price. So e.l.f. is good in any environment. That's one of my theses many years ago when I invested in the stock for the first time, was that they could handle any environment out there, which they've proven they can do that, right? Unit volume growth. Look at this, 33% unit volume growth versus -7% for L'Oreal, -7% for Maybelline, -6% for CoverGirl, -9% for Revlon. Insane. If we look at the skincare market share gain just in the past few years, they've 3x'd that. 3x their market share, but they're only 1.6% of the market, so they've got a long runway of growth ahead in the skincare category, right? If you look at e.l.f. dollar share for color cosmetics, they're at about 10.5%. I think that's where they're going to probably go with skincare over the coming, you know, next 5-10 years, is somewhere around that 10% type share. So long runway of growth ahead in the skincare category, like absolutely crazy. This is still a baby business for them overall. No, this goes ahead, and this is a teen survey that Piper Sandler does, okay? And they survey teens and kind of ask them what their favorite brands are in specific categories and whatnot. And what they found when they asked teenagers what their favorite cosmetics-related brand was, e.l.f. destroyed everybody. They got about 38%, which is up 16 percentage points versus last year. The next closest was this company named Rare Beauty, 9%, Maybelline at 6%, Charlotte Tilbury at 5%, and Fenty Beauty, which is, if I recall, is a Rihanna company, 4%. So they're destroying their competition. They're what teens want at the end of the day when it comes to cosmetics overall, which guess who the future customers are of e.l.f. for the next 10, 20, 30 years. It's these folks that are teenagers now, and then they're in their 20s and 30s and 40s, right? And so e.l.f.'s snagging a lot of these folks when they're very young. Speaking about very young here, this was a survey they did, number 2 most purchased by millennials in terms of e.l.f. So they've really done a great job of capturing the millennial generation. But look at this, Gen Alpha, which is still wild to me that Gen Alpha even buys any sort of beauty products or cosmetics, but they do, which is Gen Alpha is like 6 to 11-year-olds. And who did they even survey for this? Like, this is another company that does this sort of survey, but I'm like, they must have to talk to the parents. They're not talking to 8-year-olds, are they? But number 1 most purchased by Gen Alpha overall, which I know this all sounds silly, but at the end of the day, like, who do you think is going to buy these products 10 years from now, 20 years from now, 15 years from now, right? It's going to be the younger generation. If they like the brand now, there's a good probability they'll like the brand in years to come as long as they continue to do a good job of marketing, which, speaking about marketing, the company's upped their marketing investment considerably. They're basically this past fiscal year, they're basically using about 25% of their net sales on marketing, okay? Which is a huge number. I mean, an absolutely huge number. So they're doing major spend here. Now, they could just cut this number down significantly and cut it down to where it used to be at 7%, 13%, 16%, and that would help the profitability of the company go up immensely. But if you're e.l.f., why would you want to do that right now? You're growing revenue and market share at an absolutely astonishing pace. You're setting yourself to be the number 1 cosmetics beauty-related company in the world. Let that sink in for a moment. In the world, number 1. That's what they're setting themselves up for. When you look at e.l.f.'s market share gains, and you look at where this company's revenues are headed in the brand, you can see how this will be the number 1 cosmetics beauty-related company in the world by the end of this decade. And when you look at it from that context, it's like, maybe we should hurt our profitability in the short term and spend on marketing because, dang it, I think it's pretty darn valuable to be the number 1 beauty brand in the world by the end of this decade. And that's the path that e.l.f. is on over here. It's a whole different game plan. So to be quite honest, although I love profit and I love the net income and I love that earnings per share, for e.l.f., they need to focus on marketing, because what they're doing is working. And what they're building here is the number 1 cosmetics beauty-related company in the world. And so keep spending that money. Now, they've got some big things coming up here. In the springtime, they're going to be getting shelf space expansion into CVS, and then they're getting more shelf expansion in CVS in fall 2024. Anybody that's not from America, you might not know CVS. Anybody that lives in America, you know CVS because they're practically on every other corner. Them and Walgreens are the 2 most famous pharmacy chains in the world, right? Well, I don't want to say in the world, but certainly in the United States of America. Then Walmart. They're getting space expansion in Walmart. Now, this is huge because if I look at the one store that I feel like, here's the deal. e.l.f. doesn't have enough shelf space in any store right now. They're way over indexing. So basically, e.l.f. has like 5-10 years of runway ahead just in terms of shelf space gains in all the stores, even Target, which if you go into a Target and look at the shelf space that e.l.f. has, it's massive. It's still not even remotely close to what they should have, given how much volume they do from their section versus these other companies. So e.l.f. even in Target should be gaining more and more shelf space over the coming years, which is crazy because they're like the big dog already in there. But Walmart, their sections in Walmart are so small from what they should be. Their sections in these Walmart stores should be somewhat comparable to at least where Target's at today. When you think about the price points and the brand, it's perfect. Like, they should have the biggest section in Walmart, no doubt about it, right? So this is a huge, huge thing for the company overall. Now, Also, that new brand they bought, the Natrium, I can never pronounce it correctly, they're expanding into Ulta this summer as well. So they got e.l.f. expanding shelf space in Walmart this summer, and then on top of that, this new brand they bought is expanding into Ulta, and that's big. Like Ulta, you know, that's the holy grail in terms of trying to get skincare products into Ulta Beauty. So massive for the company overall. Now, international, there's so many growth levers all over this company, it's hard to even fathom, okay? International is about 15% of the company right now. International penetration, 15%. Their major public peers are around 70% or so. That's where e.l.f.'s going long term. So this is going to flip over this next 10 to 15 years. Like, it just makes sense. Like, there's way more people to buy cosmetics products outside of the United States of America than inside the United States of America. Why? Well, there's a lot more people that live outside the United States of America versus inside the United States of America. And because e.l.f. is so successful on social media, it makes it very easy for them to expand in new markets because they already got their customer base there. Because guess what? TikTok's used around the world, Instagram's used around the world, all these different social medias, YouTube and whatnot, right? And guess what? People are already familiar with e.l.f.'s brand in other countries before they even have a big presence in that country. So the international expansion over this next 5-7 years is cake. It's cake for e.l.f., okay? And there will be a day when international is making up 50% plus of their business, right? And it's not in too far of a future because that is just, and also do the math, right? It's compounding numbers, right? You look at that international growth rates, 115%. Nice. They have just an extraordinary opportunity international over the coming years, right? Now, if you look at adjusted net income, $31 million it did in this latest fiscal year quarter versus $24 million, same quarter last year. And if you look at most recent EPS, you know, it's growth, but that's not the focus of the company. They're focusing on marketing, employee force, expansion, costly things, right? But there will be a day when e.l.f. on a shelf is an absolutely ridiculous net income maker, earnings per share maker. It's not today. That day will come, but right now it's all about revenue and it's about market share because you're going after much bigger opportunity here, okay? Now, as far as the fiscal year 2025 outlook, if you're wondering why did the stock go to the 130s after hours yesterday, right? And then all of a sudden, next thing you know, it's 180s here. The reason it went to the 130s after hours yesterday is because the initial outlook came out. And the company was talking about 20 to 22% net sales growth, right? Whereas the company's been recently doing like 70% plus, right? And so the algos all freaked out. All these Wall Streeters freaked out. They sold off the stock, right? And if you were watching the live stream, what did I tell you yesterday on Twitch? I said, this is a clown show. They're going to buy this stock right back up. They don't realize what's going on here. e.l.f. always comes out with low guidance, and then guess what ends up happening? They come throughout the quarter and beat numbers and beat numbers and beat numbers and beat numbers. And I said, these same clowns that are selling off this stock are the same ones that are being buying it back tomorrow and next week and next month and paying $150 a share and $200 a share. And sure enough, it's exactly what played out, right? They didn't understand, like, e.l.f. did the same thing last year. They put out a low guidance, and then they came in, crushed numbers. Then they came in, crushed numbers again. They upped their guidance for the year, right? And I think they actually upped their guidance multiple times throughout the year. What do you think is going to happen this year? The same flipping, flapjacking thing. Come on, man. All right, let's get an evaluation around NVIDIA here.
Point out a few weeks ago that you thought we broke our addiction to Fed commentary and speculation. You thought that was healthy, although it doesn't sound like you think that's going to last.
I think for the last few years, it's not just the last year, I think this fixation on what the Fed will or will not do has distracted us from the fundamentals. From that perspective, I think the less talk there is about the Fed, the healthier the market becomes.
That's unlikely. I guess, is that a function of the volume?
Is it crazy to think NVIDIA could be the biggest market cap in the world before the stock split or shortly after the stock split? I don't think it's crazy. I could see it potentially happening. I mean, within the next 1 to 2 months, I think it's very possible NVIDIA could become the biggest market cap in the entire stock market. It's very possible. Not a guarantee.
Commentary, or is the market just primed for that no matter what?
It's the delusion that the Fed sets interest rates that drives me crazy. I mean, the Fed influences rates, but it doesn't set rates. And I think as long as we believe the Fed can do whatever it wants, our investing is going to be, we're not going to invest based on what really matters.
All right, so that brings us to tech and what NVIDIA told us this week. And I guess the degree to which some argue they either sucked oxygen out of the room or fed the room oxygen. What's your general take on the space?
I think it's a testimonial to the power of momentum. I mean, right now the momentum is clearly with NVIDIA. They can do nothing wrong. Everything they touch turns to gold. And we've seen this with other stocks before. We saw the Tesla in 2020. We saw it with Facebook and Google in the middle of the last decade. When the momentum is with you, nothing can stop you. And right now the momentum is with NVIDIA and it's carrying it forward. But if you look at the numbers themselves, the question you got to ask is, what are people measuring these actual numbers against? What are those expectations? Because right now, those expectations seem to be whatever we do, NVIDIA will beat it.
Well, I mean, when you talk about the momentum when it comes...
In all due respect, sir, yeah, that's because that's what they have been doing. Like, every time they say they're going to do a number, they come out and beat the number. Every time Wall Street comes up with their estimates, they beat those numbers. And they have been crushing them quarter after quarter after quarter after quarter. So, you know, at some point that will stop, but it's not right now, right?
NVIDIA, the momentum is actually in its business, right? In addition to it being in its stock. And so it seems as if, you know, the market has been sort of dragged higher in terms of how much they can expect in revenue and earnings growth going into next year based on the order book and based on what they say about demand over supply. To me, the interesting question is, at $2.5 trillion of market cap, what is the stock discounting at this point in terms of longer-term growth rates?
That's really the question. When all momentum has its source in something solid, in this case, NVIDIA's earnings and revenues have blasted through the roof. That said, though, at a $2.5 trillion market cap, you're building in an expectation that either the AI chip market is going to be $1 trillion, which it's not going to be. There's no way that the chip market alone, the AI market might be 2 or 3 trillion, but the chip market cannot be that big. Or you're building in the expectation that NVIDIA is going to find a couple of other really big markets to conquer over the next decade. Either way, I mean, it's clearly a possibility, but is it plausible? I don't think so.
Outside of AI,
that's not the right way to think about it at all. Not even close to being the right way to think about it. Let me show you how to actually think about a subject like this. All right, folks, so here's how you actually want to think about valuation in regards to stocks. And here's what you actually need to take into account. It can't just be feelings about, oh, what if they, you know, I think this market might be this much or it might not be this much. Like, you can't do that, okay? Here's how you actually have to do it. You have to look at forward P's, okay? Forward P is very important. That's taking the next, 12 months into account of what a company's expected to earn roughly net, right? Now, keep in mind when it comes to NVIDIA, whatever forward P you see, right, which for 1000xstocks.com, we're taking it into account like analyst expectations on average, right? So analysts have been clearly wrong about NVIDIA. So likely the forward P of NVIDIA is considerably cheaper than whatever it says, right? And that goes for not just 1000x, but if you see forward P really anywhere out there, it's likely much lower than it says. Okay, so just a little food for thought in regards to that. Secondly, you've got to think about it in terms of what are the growth rates this company's putting up? What's the growth rates this company can continue to put up? So if we look at NVIDIA, obviously they're growing at a ridiculous clip. They're growing triple digits on their top line, right? Next year, they're expected to have a major slowdown in growth, but still do like 26% revenue growth next year, right? Which would far outpace, peers. If you're going to put NVIDIA versus peers, you're going to compare them with companies like Amazon and Apple. You can't even really compare NVIDIA with AMD and Intel and companies like that anymore, even though they're kind of in the same space, because those companies are just so far behind NVIDIA. So NVIDIA is such a massive company now, you really got to compare them versus other major tech companies that you might consider buying, like an Apple or an Amazon. So you're talking about a company that's probably the reality forward P is probably like a 39 or a 40, right? Which is roughly around where Amazon's trading. But here's the deal. NVIDIA has much higher growth than something like an Amazon, right? Which I own both stocks and I'm a bigger investor in Amazon. I love Amazon. But I do have to be honest, NVIDIA is likely going to significantly outgrow Amazon revenue and EPS for the next 2 years, meaning this year and next year, okay, 2024 and 2025. And that's not even really a question in my mind, right? I think 2026 and beyond is more of a question mark because then it's like, okay, what happens if, orders start to slow down for NVIDIA back half of 2025 and going into 2026? then you could be talking about NVIDIA, sees a massive slowing in the business model and potentially a big fall in that stock price, right? But at the end of the day, I think it's hard to still make a case that NVIDIA is some crazy overvalued stock just based upon the fact that they have this sort of ridiculous growth. And is there anybody that's going to eat into that growth? Not really. Is there something that's going to end this growth right now? No, because we know all their biggest customers are usually the biggest tech companies in the world, and all those companies have already committed to their budgets for this year and are already soft committing to their budgets for next year. So we know these NVIDIA chips are going to continue to be bought up heavily, and not just the chips, but everything NVIDIA has going on in their business model for not only this year, but next year as well, right? Which means their valuation, it's hard to make a case that this is some crazy overvalued company, right? Now, if the stock keeps running, you could start making a case that I made for Tesla years ago, where essentially the valuation gets pushed so much that the stock could basically either downtrend or stagnate for several years, right? That happened with Tesla, but I actually still don't think NVIDIA's quite got there, right? This stock would have to move up another considerable amount for me to start to say, okay, this looks like a level that NVIDIA is probably close to topping at, right? And remember, even when I was making that case around Tesla didn't really truly top for another probably, what was that, 6 months, maybe 12 months. So let's say NVIDIA keeps running, that stock keeps running the next few months, and then I'm able to make a case about, okay, NVIDIA's probably setting up for a big downtrend or stagnation for a given time period, right? I mean, it could still be many months before that stock actually finally tops for real, right? Because when a stock finally really tops for real, that's an acknowledgement by kind of almost everybody in the investment community about, okay, this company's numbers are likely going to start. We've seen kind of the peak, or we're close to the peak, and the downtrend starts, right? But NVIDIA's not there yet, right? They're going to get there, but they're not there yet. And so everybody's been trying to jump the gun on this and just been wrong again. That's how you actually got to think about valuation. Don't make it more complicated than what it should be. And try to take opinion out of it as much as possible. Look at growth rates, look at likely future growth rates, look at forward PE, take those things into account.
How do you perceive the valuation gap in the private markets versus the public markets? We're hopeful and waiting the potential for some IPOs this summer, hopeful from the standpoint of activity down here at the NYSE perhaps. But we keep hearing instances that there's this gap between the valuations that the companies looking to go public are looking to get versus what the buy side is willing to pay. How are you kind of observing this dynamic?
I think there is a gap between not so much public versus private, but money-making big tech companies and money-losing small tech companies.
Fair.
While tech has gone up a lot over the last year and a half, much of it has been at the top of the ladder, the large market cap money-making tech companies. And part of the reason I think we're not seeing the IPOs that you'd expect to see when tech is doing well is because of that disconnect. That disconnect might disappear if the market keeps doing well. But for the moment, I think that's what's separating the two.
Yep, 100%. Right on.
I guess I just want to drill into the NVIDIA point. Just one more thing, because people keep saying that, the stock is cheaper today than it was 2 years ago because earnings estimates have come up so much. It's a company with like 80% market share, 75% gross margins. And one of the skeptical takes is that just both are maxing out right now. In other words, returns that high will inevitably draw a lot of better competition. So I guess the question is how we handicap that dynamic.
I think NVIDIA is going to beat expectations in the short term because everything is based on 1 year revenues, 1 year earnings. The question is there enough boost, enough size in this market to keep it going as long as it has to justify the market cap? That's where I'm holding back because I think it will continue to beat expectations in the next quarter, maybe the next couple of quarters. But I think that's, there's a long-term game and a short-term game, and it depends on which one you're playing with NVIDIA.